Risk management is the key to maintaining your assets when you're trading, right? So ultimately, when you get into trading, it's all about, where do I buy? Where do I sell? And a lot of the time, people don't necessarily think as much about preservation of capital. And it's absolutely crucial. This highlights exactly why that is, right? Let's say you start off with $1,000, $10,000 in your account, and you think about, right, I need to get from $1,000 to 2 to 3 to 5 to 10 and along those lines. Well, what invariably happens is that you start to lose a bit of money, and you might go from, say, your $1,000 down to 500. Well, you've now lost 50% of your portfolio, your account size. As we can see here, you then have to make 100% gains to be able to get back up to be even, right? And this highlights that certainly the drawdowns are a major point of contention when it comes to trading. This is another way of looking at it. You can see the discrepancy between the initial capital and the amount that you have to recover. And it starts to really ramp up at that sort of 20% threshold kind of area. So once you've lost 20% of your account, all of a sudden, like for example, if I lose 1%, I only have to gain a little bit over 1% to recover. It's not a major difference. If I lose 50%, I have to make 100 to be able to get back up to the top, right? Or back up to where I began. And generally 20, 25% is where that discrepancy really starts to kick in. So you don't want to lose 20, 30, 40% of your account, really. And so you need to kind of try and preserve your capital, particularly at the beginning. But part of that is going to come down to position sizing. Now, note that no trader gets every trade right, and you will have losing streaks. And sometimes, if you've gone to a casino, for example, and you've played a game that's supposed to be by and large evens, you just have a period where, for example, if you're playing roulette, it goes black and black and black and black and black over and over again, right? And you think, what are the odds of this happening? Unlikely things happen within trading, within gambling, within games of chance. They just do, right? And so let's say you were trading and you were trading with 50% likeliness win rate trades. Essentially, you're trading, like I said before, with a trade that had a stop loss and a take profit, which are equal distances apart. You might say the likeliness of either happening is evens, right? It's as likely to go up as it is to go down. So what's the likeliness that you hit a streak of losers, even though you're taking trades that are even by nature, right? We can see here that by and large, even when you're taking 50% trades, there's a strong likeliness that you're going to be getting 6 in a row, right? So 6 losers in a row is what you have to be able to suffer without getting back down to losing, say, 20%, 30% of your account, right? Because it will happen at some point over an extended period of time if you're trading for a prolonged period of time. So let's say you've got a different kind of win rate, you can sort of look along this curve, but periods of losses are going to happen, and you need to be able to maintain your assets along those lines. So let's say the number of trades that we're losing here is 6, right? If you are taking a 2% per trade strategy, you'd have lost roughly 11% of your account. It's not at that 20% threshold. If you're utilizing the 3% strategy or 3% risk per trade, you'd be looking at roughly 16, 17% of your account. So still below that 20 threshold. If you're risking 5%, it would be above that. It'd be like 26%. So 2, 3, 4% of your account risked is kind of doable if you're doing sort of 50-50 trades. I mean, obviously you can adjust all of these thresholds yourself, but you need to make sure that you don't get down to that sort of like lost 50% of my account threshold, because you need to be consistent in nature in terms of how much you're losing to be able to then grow your account. And you do have bad periods. So you need to have those losing streaks, sort of losing less than you would do otherwise. If you're risking 30% of your account, it's going to blow up, right? Because we have those tough streaks, even when you're taking trades that are even by nature. And this highlights the sort of impact on your account if you're trading with a 2% risk versus 10% of your account risk. You can destroy your account very quickly by risking a huge amount of your account over that period. So ultimately, you know, I think that position sizing is absolutely key to be able to access the benefits of compound interest within trading, and arguably focusing on what the reliable trades are, what the reliable markets are, being able to get small, little and often gains, trying to get to the end of each month and be able to note it down and say, hey, I hit 6% this time, I hit 4%, I hit 8%, averaging that out and just building. It may not feel like a lot at that time, but if you fast forward and you have the power of compound interest within trading, then you can have really dramatic gains that can be achieved for you. Now, we're essentially talking about, you know, different markets and different trends within markets, right? And certainly when it comes to the most reliable markets, they have been proven to be US equity markets. When I choose markets, I look for the most reliable and the most predictable markets. And what I like when someone sees a trade that I've done right is that they say to me, well, obviously that was going to happen, right? Because it's such a clear-cut trade. It's such an obvious trend. And so I don't try to find markets that need to be entirely deciphered and you have a huge mess of charts, of candles around on my chart. I like nice, clear-cut trends, things that have happened time and time again, happening once again. So the key to long-term trading success in my mind is the ability to not destroy your account, to grow it in a gradual nature, to be able to utilize the benefits of compound interest so that you're increasing your position in nominal terms, but maintaining it in percentage terms, trying to utilize the benefits of historical data to know what the reliable markets are. Also trying to look at what the current trending markets are, because you're going to have periods where, for example, gold will be in a lull. It might have years where it's underperforming, and then suddenly it's coming into this phase where it's like super reliable as it has been recently. You need to be able to know what the trends are of that time and be able to take advantage of that within your short-term trading. So there's the investing side of things, which is looking for the long-term trends and seeing how you can benefit from that. And then the shorter-term trading also utilizes those longer trends, but also tries to find out what the current trends are within the markets right now and try to utilize that.